I'm absolutely delighted you can join us today, and welcome to, I know, the very many who will be watching this via the recorded podcast as well. This is the first time we've done research on climate risk and on asset owners' views of them, with indeed also their view on sustainable investment. This discussion today is in follow-up to research that we have undertaken with asset owners over the past couple of months. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. One of our monthly publications is called Sustainable Investment Intelligence, which is where we will be publishing the full results of the research that I'm just going to briefly go through the main summary of in a few minutes. But before getting into that, let me start by quickly saying why we did this study. There is, as many of you doubtless know, there is quite a lot of research already out there saying that pension funds and other forms of asset owners are taking climate risk more seriously, but there is nothing, at least that we know of, that really goes beyond that in terms of how they use the data, what data indeed they use, how it impacts their allocation decisions, and in particular, and this is, I think, really the most important point of all, the motivating factors for the really big jump in investments that we see going on at the moment into various different parts of sustainable investing universe. Probably the largest single reason for wanting to do this was to try and explore the link, to see indeed if there is one, between asset owners' views of climate risk and what they're doing in terms of sustainability investing. Now, we probably wouldn't have been able to conduct this study if it wasn't for the fact that our publication, Sustainable Investment Intelligence, has a database of about 500 pension funds, which have combined assets of something in the region of $20 trillion. We also follow sovereign wealth funds and a number of family offices as well. Very luckily, many of these entities, at least in the sovereign wealth fund and particularly in the pension fund categories, are very transparent about what they are doing in sustainability and their views on climate risk as well. And a large number of them publish what are called by many of them climate risk action plans, which is very helpful. We also spoke in the fieldwork period for this research to a number of sustainable GPs and some advisors, and we will be following this up with a number of projects that will flow from this. So now let me quickly introduce the panel before I go into the headline findings. With me today, I have Chris Addy, who's the CEO of Castle Hall Diligence. He's based in Montreal. Castle Hall, I think I'm right in saying, Chris, you work with over 200 asset owners around the world. Welcome to you. We have David Hawkins, who is the climate lead of the Next Energy Group. He's here in the UK with me. We have Dr. Jeremy Porter, who's the chief economist of First Street. And I'm going to ask them all, by the way, to say a few words of introduction when we get into the panel session. And sadly, very sadly, just a couple of hours ago, Georgina Thomas, who's the head of impact at Kibos Capital, has fallen ill and is not able to join us today. So sorry about that. So let me get started with some of the key findings as we see it from this study. The first is that asset owners want more climate risk data to be granular and more integrated with investment risk than has been the case to date. For example, CalPERS is looking at the link between climate and financial risk at the moment, seeing what more that can be done in that area. Very big pension fund in Sweden called AP7, part of the AP series, is doing the same thing, but they're taking it a step further and looking at biodiversity and deforestation along as part of what they're doing in climate risk. Secondly, pension funds are often allocating to the sustainable sectors for climate risk mitigation reasons. That's a growing phenomenon. When this all started, however many years ago it started with negative screening, and then it slowly developed into doing various positive things along the way. By negative screening, I mean just avoiding heavy polluting industries, the oils and gas of this world, and more recently, any industry or any business there's a large carbon emitter. That, of course, is still going on, but people are, or in the institutional space, looking for more positive outcomes as well. Thirdly, investment into natural capital projects. We particularly noted this year of all years is growing at quite a pace. And it's significant part of the reason, not the only reason, but a significant part of the reason for doing that is to mitigate climate risk. And examples of that even go down to very specific smallish pension funds, like the West Yorkshire Pension Fund, which has taken a 25% stake in a natural capital manager, back up to very large pension funds. The largest one in Europe, ABP, is targeting, it's announced, it's targeting to spend or allocate €1 billion in the next year or two into biodiversity and nature. Comparing climate risk with other risks is difficult for asset owners, really because, and this comes out in some of the big MSCI type studies, Morgan Stanley type studies, of which there are very many. They don't really necessarily drill into perhaps the reason why. Of course, everyone is going to say market risk and other obvious day-to-day risks are of greater importance on the short-term time horizon. That's definitely the case. But if you look at climate risk, it's clearly a much longer duration problem, and these are investors who are investing for 20, 30 years, and so it is more critically important to them than perhaps to any other investor class that they get this right. But comparing it, just ranking it alongside market risk or any other risk you care to name, liquidity risk, for example, or whatever other risk you want to say, is just difficult because of the time horizon issues. But you have pension funds like PFZW in the Netherlands and a few others who are now saying climate risk is equal to market and credit risk. This is very new. That wasn't said a couple of years ago, but it is. And I would guess if we were here in another couple of years' time, there'll be more that will be making perhaps that point. Climate as investment risk is becoming an asset class specific for large asset owners. Obviously, it affects asset classes like real estate and infrastructure more than some others. CalPERS at the moment is working on developing its own criterion for strategic allocation, incorporating climate risk. This is relatively new. BVK and ABP are rolling out climate risk analytics across their real estate portfolios at the moment. And they're apparently looking to do that in some other asset classes too. They're obviously starting with the most obvious ones and moving into other ones in the future. One of the points that we found in doing this research is that it can take pension funds a very long time to make changes to what they do. When they put up on their climate action plans, when the action actually happens, can be years away. There's a pension fund here in the UK called NESP that is in the process here in 2025, implementing plans they first announced back in 2023. Large asset owners move on to the next one. Large asset owners are often developing their own systems for climate risk, but the vast majority of the ones, particularly if you go beyond the really well household name pension funds, you find that still, or most of them do work with external firms, except in the US, where in the US, typically, they do tend to rely upon their third-party managers for what they want to do in climate. Outside the US, as I say, the large asset owners, the pension funds, the sovereign wealth funds, are working often developing their own systems. And there is a trend, it's quite an interesting trend in certain places, for universities to work with them. Here in the UK, one of the largest pension funds we have is USS. They have a joint venture with the University of Exeter. They're doing various things in climate risk. The Grantham Institute at the London School of Economics is, I believe, working with a number of investors of every shape and size, not just the pension funds, but others as well. And OMERS, which I believe is a Canadian pension fund, is interestingly enough has teamed up with Oxford University to do a number of things as well. So this is very much a developing area. It's got an academic dimension to it, which is very interesting. And I'm sure there are many other universities here in the UK, elsewhere around the world, that are doing similar things. I haven't mentioned family offices yet. There's quite a lot of it's more difficult, obviously much more difficult in some cases to get the information off the family offices, but we've got a reasonable amount of it. Where they really are developing and taking a lead is in green tech. And there's phenomenally bright people that work in some of these family offices. They really get the technology, they understand it, they find it interesting. I think that motivates them to do more as a result. There's quite a lot of multi-family office activity coming in together to do certain things. There's a family office venture capital fund, which I understand quite a lot of families have contributed to, and there are doubtless many other examples of that. Climate tech is a big growth area in the wealth management sector in different ways at the moment. We calculated SII with all the data that we analyze. There's been a 30% increase this year in family office allocations to climate tech. And most of that, not all of it, but a lot of that is in the renewable space in one way or another. There's a growing trend, renewables, which I'm going to come on to say a little bit more about in a minute, is still the fastest growth area. It has been for a number of years and probably will remain so for the time being in sustainable investing. I'll save comments for that for a second. And there's a growing trend by large asset owners to invest directly or co-invest, but not use third-party funds. That's a trend, by the way. If you look at all private market investing, that's happening across the board, outside sustainability as well as within it. But I think it's taking the lead in different forms of sustainability. The asset owners are much more interested in going directly if they can, rather than using the traditional structures that are out there. So, for example, a sovereign wealth fund, probably maybe the largest that there is, the Norwegian one, has taken stakes in several offshore wind projects. And I think in each time they've taken a 49% stake. They've also invested directly in various solar farms in various places. And they're huge, but going down the scale to the Clwyd Pension Fund in Wales, that's doing its own thing in managed account space when it goes into renewables. And Hoop, if I'm pronouncing that correctly, Chris, in Canada, is doing a lot of co-investing in renewables as well. And the Aussie super funds, Australian superannuation funds, are also very much into different forms of co-invest if they can. What asset owners understand climate risk to be? That's maybe an interesting question. We could spend a long time talking just about that. I think it's still the case. It's changing, but it's still the case that emissions reduction screening is what they would understand to be the first and most important thing for them. I've already said there is a move away from that negative screening into more positive outcomes, and I've cited some examples of that already. Many Nordic pension funds see climate risk as part of their overall sustainability investing plans. they don't see it particularly the same way as the US pension funds do. And then you see at the moment, particularly this year, nature and biodiversity loss increasingly being linked with climate risk as a concept and investment risk as well. And that's something that many Dutch and particularly UK pension funds and some other Nordics have been emphasizing. Many Australian and some Canadian pension funds explicitly include litigation and liability risk when they talk about as important areas that are equal to other areas when it comes to climate risk, and that is, but that is relatively speaking unusual for that to happen. It does happen, but many of those there was a famous case down in Australia recently where they got sued by their beneficiaries. The one thing that keeps them really awake all night is the idea of being sued and the reputation risk that is created as a result. That's one of the motivating factors. We may get into the motivating factors of pension funds, particularly in Canada, Australia, and Northern Europe, for doing what they're doing. And that may be, I think, an important part of it. Where climate risk is lacking, there is this comes out of the vast body of the research that we have been doing, and it comes out time and again in different ways. There is a need for more specific, if it could be possible, and we're going to be talking about this in a minute, there is a need for a more specific physical and detailed physical and transition risk data, if that's possible. Pension funds often say there are big gaps in the data in some asset classes, and some are very open about it. They even mention when they're giving their reports that we read regularly that we don't have data in this area or that area, so this is done on the best endeavor basis, but we don't have the full data that we should have, and plenty of those that do cite that. And asset owners would like, definitely, if they could get it, more alignment by data providers. As they say, very little, if anything, really matches. Everyone's doing their own thing in their own way, and there is a lack of collaboration, they say, between them. They would love it if it's possible. It may not be, certainly not for the time being, to have some form of standard industry metrics. Everyone wants reliable data that the industry has agreed upon. We know we're not there yet. Again, we'll get into that discussion in a minute. And finally, alignment of climate, financial, and scenario data. If there are entities out there that can provide that we did talk on the prep call about frameworks for bringing stuff together. That would be a dream for many, many, many asset owners in many different ways. I said earlier, I'm going to talk about this very quickly because I'm conscious of the time and I want to get into the panel discussion as soon as possible. This is a quick overall view of our SII database, the pension funds, the sovereign wealth funds, and the family offices. This year we added foundations to this. We're more including that in this here. Here is an extraordinary figure to me. 98.2% this year of these entities I've been talking about today are investing in renewables in one way or another, up from 97.1% last year. But the really interesting thing is it's almost complete market saturation, that nearly a third of them increased their allocations. So this year, and that's, I think, probably the most underreported story in the investing world that we know of in the year of 2025. Biodiversity, nature, rapidly coming up on the rails. The TNFD, which we don't have time to get into now, came in a couple of years ago. That's really making having an impact in a very positive way on that category. There you see it on the screen. 58.6% of these entities I've been talking about today are now investing in biodiversity and nature. If you went back 3 or 4 years ago, it was nothing like that. There was and then again, 18.8% of what was done last year is an increase into natural capital areas. Then you have the 3 others down below, quite a lot smaller in terms of increases. I've never understood why forestry isn't a bigger asset class than it is. I think with the whole carbon credits thing, it will, and tokenization, subjects we won't get into today, it will be increasing quite a lot in the coming months and years. But it hasn't really been very exciting for many investors until now. Water and waste stroke the circular economy, there you see it. Quite a surprisingly large allocation to a very specific area, waste and the circular economy, but still relatively small increases in those three at the bottom of the chart. Quickly to sum up, because I want to get to the panel, 3 points to perhaps leave you with before the panel discussion. I really do believe we're still at very much the early stages of what is a multi-decade development. The kind of things we're talking about today wouldn't have been possible 10, perhaps not even 5 or 6 years ago, certainly not 10 years ago. I've been around long enough to remember the early days of emerging market investing, and I do see quite a lot of similarities as to what's happening in sustainability and with the early days of emerging market investing. Of course, there are many differences as well, but there are a lot of similarities that I see too. And I really think, just like the emerging markets, I think in terms of the emerging, this is the equivalent of the very early 1990s in the emerging markets. And I think we've got a long way to go in terms of growth in the coming years or decades. Asset owner investment, I've already pointed this out, into sustainability is growing rapidly. I don't think the mainstream financial media are anything like understanding how fast it is growing, and we're going to get into the motivating factors for that in a second. Finally, asset owner understanding of climate risk is becoming more sophisticated. It's a very complicated area. There's lack of historical data. There's all sorts of issues. Again, we'll get into that in a minute too. And it does take them a long time to implement the changes they want to implement. I gave an example of that in my presentation, and that will doubtless remain the case in the future. But I do think you will see a greater degree of sophistication. I think on the provider side, you'll see a greater degree of sophistication and usability of the data in different ways coming up as well. So I've rapidly galloped through as fast as I possibly can. Let me get to the panel. And if you guys wouldn't mind starting off by just telling a quick word about what you do. David, you're at the top of my left of the screen there. Perhaps you could say a little bit about your role, and then I'll go ask Chris and Jeremy the same thing, and then we'll get into the questions.
Yeah, no problem. Thanks, Simon. A pleasure to be here. So effectively, folks, I am a senior vice president in the Next Energy Group for the sustainability team. I also have the sort of the moniker of the climate lead, and I also handle the fund level regulation. So what I would say is what we look after with our group is it's kind of there's a number of subsidiaries. Probably the most relevant three are there's a renewables developer, which as a group we're more focused on solar and battery energy and storage solutions. The first part of the subsidiary is a developer. Another subsidiary is Next Energy Capital, which manages 4 funds, a mixture of private and public, and we have UK and international interest under those funds, roughly about sort of 4 billion pounds under management. And then finally, another relevant subsidiary for this conversation is our asset manager, Wise Energy. So as part of the group, I kind of look after the climate elements across all parts of that group.
Thank you. And Chris?
Again, Simon, thanks for the invitation. I'm Chris Addy, the CEO and founder of Castle Hall Diligence. We support investors and asset owners worldwide conducting due diligence on their third-party investment managers, primarily with a focus on alternative investments, be that public market hedge funds or private markets across private equity, venture capital, real estate, infrastructure, and private credit. As you mentioned, Simon, we support more than 200 allocators worldwide, and that I think gives us quite an interesting perspective. Collectively, our clients allocate to about 2,500 external asset managers and portfolios, and as we conduct diligence on our clients' behalf, we certainly have seen an increasing flow of a variety of sustainable strategies, be that everything from renewables, infrastructure projects, through to, yes, we have actually done quite a few forestry and farmland structures. We also have a dedicated ESG diligence service where we look both at the ESG characteristics of an asset manager, as well as the conduct of the investment process when a fund is bringing assets into their portfolio to verify and validate that environmental, sustainable, impact responsible factors are actually considered in that process in the spirit of trust but verify.
Thank you. And Jeremy.
Yeah, thank you again for the introduction. I'll bring in a slightly different accent, I think, into the group here today. But I'm Jeremy Porter. I'm the chief economist here at First Street. In my role, I sit downstream of our climate hazard modeling team. At First Street, we are a physical climate hazard modeling company. There's an example in the background behind me. We create high-resolution climate hazard models that get integrated directly into risk modeling frameworks. I think the discussion today is really interesting to us because we're building our own tools for integration into risk processes. In fact, an article in Bloomberg yesterday just covered our work, and basically the article said economic risk is climate risk. The two aren't different from one another. I think for the last 10 years, we've looked at them as different. Some of what Simon covered in terms of how people are thinking about climate risk and integrating it into climate risk frameworks has been in opposition, but we're slowly seeing that change. And a lot of that is just the response to what people are asking for, and the fact that this is such a new way to integrate data that at First Street, what we're doing is we're taking feedback from asset owners, from asset managers, and we're integrating it directly into the enterprise suite and other tools that we have here at First Street to answer those questions. I look forward to talking about the data a little bit later today.
Yeah, let me start with the following, if I may, to all of you, which is that what is your assessment of where asset owners are going with their assessment of climate risk? In fact, where they've come from a little bit, as well as where they're going to be going in the future, and what link you see, if any, between what they're doing in climate risk and their allocations into the sustainable sectors, and how you might see that evolve. Jeremy, perhaps we can start with you on that.
Yeah, and I think our perspective, right, is as a physical climate risk hazard modeling company. So what we're seeing is that people, over the last 5 or 10 years have been really interested in risk avoidance. A lot of what people were producing in the physical climate risk space wasn't either at a high enough resolution or didn't translate easily into the metrics that people need to integrate into the processes that they had in place. So there was sort of this mismatch between the development of models that allowed you to understand physical climate risk in this space and the risk frameworks that are already in place that people are integrating. And really, honestly, it's the sort of siloing of ESG and climate risk analytics within organizations versus the investment teams and the risk teams, and figuring out how do we integrate those things together. I think what we're seeing recently is that people are looking at climate risk and physical climate risk in particular from our seat as a way to integrate risk into those processes. We're seeing an integration in a way in the past few years that we haven't seen in the years leading up to that. And it's really because people are thinking about it from a couple of different perspectives. On the one hand, people are starting to think about physical climate risk as opportunity and thinking about, how do we integrate this into our geostrategy? It's familiar to a lot of people when you just think about a traditional retail site analysis type of approach. You're taking demographics, you're taking economic characteristics, you're taking market characteristics. But on top of that, layer in climate risk information and climate risk information at the asset level, but also at the market, the community, the infrastructure level. And when you layer it into those components, from a climate risk company, we don't have to say climate risk is the most important thing because we know it's not the most important thing, but we can say that it layers into a more sophisticated approach as part of your overall risk analytics. And really what we've seen in the last few years, in particular with the asset owners and asset managers, has been a discussion around how do we translate this into metrics. We have a framework in place. There are a lot of different models. In some cases, there's this cottage industry, right, of climate risk analytics companies that have emerged in the last few years. And they're all producing the models in different ways. They're all producing metrics in different types of ways. So our approach has been to work directly with those individuals to create metrics that are useful to them, that integrate into their process specifically. And when you can do that, really what you're doing is pulling climate risk and physical climate risk analytics into the larger investment process. And so that's really been our strategy, is to work with people to understand the metrics that they're working with directly. And then I'll close with one piece on here. It was interesting to hear your point around the academic nature of this work, and it is to many degrees because it's an emerging piece of the risk analytics framework. It does require a level of sort of coordination across different academic or different expertise levels. And so what we're doing also at First Street, which I think has helped us in terms of the development, is I come from the academic world. Our chief science officer comes from the academic world, and we take a very academic approach. I think over time, what you're going to end up seeing is that many of these companies, many of the asset owners, asset managers are going to build internal frameworks with that same level of expertise, the same way that they have in other risk areas. It's just that it's so new at this point that it takes on the collaboration that's necessary to produce meaningful metrics.
Before we go to David and Chris, very, very interesting what you said, and what you've just said was very much picked up in the research we've been doing. But can I ask you this question, if you could give a straight, honest answer? Do you think there are too many providers out there right now?
I think there are two types of providers. So I think so the answer is yes, but I think there's two types of providers. I think there are physics-based climate risk modelers, people that develop physics-based models that are built on decades and decades of physical climate risk equations, on flood model simulations, wildfire behavior models, those types of things that allow you now with things like AI and machine learning to integrate and build really high-level inputs and then run the physics-based models on top of that to get really precise risk metrics attached to it. The big growth in this space has been statistical downscaling models and models that don't base their physical climate risk models on actual physics-based climate hazards, and they'll essentially take global climate models or global circulation models and downscale them to a level to where they can say they're asset specific, but they're not taking into account elevation. They're not taking into account fuels for wildfires. They're not taking into account friction for wind models. So there are all these things that exist today, but I think most of the growth has been in less than useful asset-specific climate risk models.
Thank you. And David, same question to you. And perhaps you where Next Energy would have been, say, a couple of years ago, as opposed to where it is today, where you think it might be in, say, 2 years' time in answering that question? Because I don't know whether you were there 2 years ago at Next Energy or...
Yeah, absolutely. I think, look, it's evolved massively and it's going to keep going. As pretty much agree with everything that Jeremy's just said, everything. I think, when we first came in, you've kind of got very high level tools and the data behind it maybe is very generic. We've spent sort of the last year and a bit looking for climate risk tools, and we probably looked at 25 to 30 of them. We've tried to build our own. It's incredibly difficult. But the tools out there are developing and evolving massively, and it's exactly what Jeremy said. You need to have elevation. You need to have sort of relevant wind speed to your areas. Especially with the type of assets. And I feel that where we were before was kind of just coming in, as an ESG department and saying, we think that the climate risk is here, whereas what we're moving to now, and I feel that this is part of what I would describe as an evolution from the ESG backlash, but also a common sense approach, is that it's pure integration. You need to talk to the engineers. You need to integrate it at that point to provide confidence to the investment management teams who are making the decisions at the IC. And that is exactly where we're heading and where we are and how we're going to evolve there. And that's where things like, the IIGCC climate risk investment framework comes in with its BCRAM approach and different elements. But effectively, what you'll find is that what we found is coming in with this data set, you're finding that, the investment managers and the investment team saying, well, hang on a minute, this is just another model. How representative is the asset characteristics? Come on, this is a completely different archetype to a generic, for example, solar asset, which may be very close to the ground, hours are higher. Is this risk even reliable? And now for us to get, sort of reputation and reliability, it's integrating it, and we're unique because obviously we, with the structure that we have, we would acquire assets normally, not always, but normally, ready to build, and we'll build them ourselves, and we will do the detailed design. So we can sort of the approach that we're working on, and I think it's going pretty well, is talking to our internal engineers who are also part of the investment management team, and sort of bringing them on the journey of identifying the appropriate tool. They understand the data that goes into it, and they layer it in, just like Jeremy was saying, alongside every other structural risk. And that's kind of the way I feel it's going, and I think that that's what our investors who invest in our funds expect that as well. They expect to see that. They're sick of these high level scenarios which are incredibly generic. And they want more from us, and it's only through this type of approach that we can really dig down on the adaptation and the resilience methodology behind that. So that's where I feel it's going.
Thank you. And Chris, I know you're not a climate risk scientist, but if you'd like to take a look, go answering the question about the evolution of assessing asset owners' understanding of it. But also we can maybe move on to the second question, which is very much up your street at the same time, which is, what are the main motivating factors for your clients and other pension funds and sovereign wealth funds that for increasing their allocations into this whole area we're talking about today? So, but you've got a sort of double barrel question here.
Well, I will apply my degree in European history to the complexities of climate modelling physics. So, I think particularly if we sort of focus on the largest asset owners in the world, so typically pension funds or sovereign wealth entities with an asset base in excess of $100 billion. That would include the Maple 8 pension funds in Canada, as well as several of the large Australian superannuation funds, Aussie Super, ART, of course, the large sovereigns in the Middle East, the Singaporeans, pension plans such as CalPERS, etc. I think the first point, these are very, very large organizations with a colossal investment footprint, a great degree of sophistication, and very large internal teams. So all of these organizations have teams dedicated to what used to be ESG, what was originally proxy voting, which became ESG, which is now being more bifurcated into sustainability. One large Canadian pension plan actually calls it climate innovation as their particular nomenclature for what we are dealing with here. And I think all of them have a great appetite and openness to consume data. I certainly ex-US. I don't think there is a large sophisticated asset owner or pension entity that is not going to be open towards acquiring and implementing more sophisticated data across the full gamut of metrics of climate behavior modeling, to be looking through to the impact on portfolios. But I think if we pivot more towards the second question, it's a very, very interesting time. And I think it really depends if we view the glass as half full or the glass as half empty. So from what motivates large institutional asset owners that typically have large beneficiary pools, that could be society if it's a country's sovereign wealth fund, or several million members in many cases if you're a superannuation fund or a large Canadian or US pension entity. clearly, climate awareness, climate investing, sustainable investing is massively further forward than it was a decade ago. And what we certainly have seen in many of our clients is the creation of a dedicated sleeve or pool of assets dedicated to sustainability. And whether that is climate transition investing, whether it is looking at external managers performing allocating to a range of strategies, everything from forestry through renewals through, I think you had the circular economy, water, etc. Great appetite for that. But I think we're equally at an interesting point of equilibrium, because clearly in the US, as we just mentioned, the ESG backlash has swung more to, and in particular states, decidedly more towards, on the one hand, the only thing that matters is investment performance. And we certainly should not be excluding key areas of the economy, such as oil and gas exploration, development, fossil fuel exploitation. And on the other hand, of course, we have the activist approach, whereby we are looking at full divestment of fossil fuel if we focus on that particular climate issue. And I think earlier on, Simon, in your introduction, you mentioned the Australian pension plan that was sued by one of its members. Now, the plan involved was REST, which is the Retail Employees Superannuation Trust. And that resulted in a really interesting settlement. But on a quite timely basis, the largest pension plan in Canada, CPPIB, the Canada Pension Plan Investment Board, has also recently been sued within the past month by a group of 4 20-year-old members who are claiming that alleging that CPPIB is insufficiently focused on the climate emergency, and as a result, their retirement assets, when they retire in 40, 50 years, are going to be materially impacted and have a negative impact on returns. CPPIB, by the way, is essentially the old age pension social security system for all Canadians except Quebec, which is some of you know is CDPQ, la Caisse de dépôt et placement du Québec. So CPPIB ultimately has about 22 million Canadian beneficiaries. And this one is really interesting. There's quite a lot to talk about, and I can come back to it later on in the conversation. But the allegation, what we really have here is the continuum between, on the one hand, looking for investment returns, on the other hand, the more extreme activist positions that is looking for full divestment of fossil fuels. And really, that's where we are. Where are these pension plans in their portfolio? They may be allocating to sustainable investments and making new investments in renewables, in solar, in wind, in tidal, looking at other renewable battery storage, for example. But at the same time, what are they doing with the rest of their portfolio that's probably 95% plus of the overall assets? And we can have them increasing, making new investments in fossil fuels. We can have them staying static. We can have them somewhat divesting. But I think there's very few out there that have completely divested. And of course, that's not good enough for the activists. So, this is a really difficult equilibrium to navigate. And I'll just finish by the article in the Globe and Mail, one of Canada's main newspapers, actually provided a quote from a CPPIB spokesperson when this lawsuit was filed. And I'm not picking on CPPIB here, but I think it's a great case study that's timely and that we can use to inform the discussion. And the spokesperson said, "Climate risks are one of many risk areas the fund has to manage as it invests to maximize long-term investment returns without undue risk." And the spokesperson said that the fund will push back against efforts that it sees as limiting its ability to meet those obligations. So I think that really is where the equilibrium is that large asset owners are acutely conscious of climate risk, but it is one risk of many that is being incorporated, and we're certainly not in a purity environment where we are having wholesale divestment. And indeed, the evidence behavior is many large pension entities, large asset owners will be increasing their allocations to sustainable assets directly through co-invests or through third-party funds, while potentially at the same time also purchasing an interest in an oil and gas pipeline firm.
Thank you. I'm very conscious, unfortunately, of the time, and I say unfortunately because we've just got 15 minutes left. So I'm going to jump a little bit onto the question, which because you've covered the pension fund market very comprehensively there, Chris. And Jeremy, can I come to you and ask you something that we talked about a little bit on the prep call, is whether climate risk data, or how climate risk data could become within the foreseeable future more granular, A, and B, more integrated, if at all possible, with investment risk?
Yeah, and so the two parts to that question. I think one is something that we talked a little bit about earlier. David also commented on sort of the progress that we've seen in some of these places. Climate risk data is becoming more granular. It takes time and it takes resources. I think one of the things about building high resolution, rigorous climate models is that you essentially need a tremendous amount of compute resources. You need a tremendous amount of time. You need a climate science team to be able to produce physics-based types of models. And when you have that, that's a large investment. It's hard to grow a new company very quickly to be able to produce global climate hazards like we have here at First Street at a high resolution without having a lot of time. We were lucky in a lot of ways. We started out as a nonprofit, spent 8 years as a nonprofit without the revenue pressures of a new company, and we were building models. We spent 8 years building high resolution climate models, and it was because of that time, that investment, that we were able to produce models that validate really well against past events, against new events as we see those events occurring. But it also is something that's very, very difficult to do. I think that the big shift in terms of creating high resolution climate hazard models, I think is going to be relative to the inputs that we put into the model. As we mentioned earlier, you can get high resolution elevation profiles, but it's not the same data everywhere across the globe. So you have to be able to complement that or integrate solutions into that to improve the accuracy of those metrics so that you have a high resolution model in places that maybe don't have the best data. The same thing with wildfire fuels, the same thing with wind models. There are all of these different indicators that now, with the ease of implementation of machine learning and AI tools, we've been able to improve our inputs and then lean on the rigorous peer-reviewed academic physics-based models that allow us to produce these high-resolution climate hazards. That's where we started at First Street. As we built them and we started to go out into the market and show those to people, people had questions for us, rightfully so. They would say, all right, 3 feet of water next to my commercial building is a really interesting finding. What does it mean? What does it mean for me in terms of the damages to the building, the downtime, the lost revenue, all of these types of indicators? So what we've done is go from the development of these models into asset-specific impacts. So we'll create archetypes to tell.
Sorry, can I stop you there? How do you go into asset-specific impacts? Because that's what our research shows a lot of people are looking for.
Yeah. It requires that you have information about exposure of the assets. You need to understand the structure of the asset. What we do is we take an archetype approach. So we'll say that this building we know is a 4-story glass and steel building that has this many square feet. Normatively, where's the elevator mechanics? Normatively, how high are the electrical sockets? Normatively, where are the HVAC components? And it gives you the ability then to build damage functions with uncertainty built into them because they're an archetype and not every building's the same. But as you move into our tools, so we also have an enterprise suite, which is an online tool where you can upload portfolios, but you could also change those assets. So if you were, an asset owner, an asset manager, and you had information about the buildings, being able to integrate that information directly gives you a more precise response and allows you to connect that back to sort of our core competency, which is the development of climate hazard models. And so you really have to understand that accuracy. And then the last thing I'll say is to the second part of your question, how do we integrate this into investable decision making types of metrics? And that's really understanding that climate risk is investment risk, climate risk is economic risk, climate risk it does represent the type of risk that people in these seats, in the investment seats, have been taking into account for so many years. It's just that we need to shape it into a metric that fits into the framework that exists today. So a lot of that is building things like portfolio analytics, understand where risk exists across your portfolio. If a concentrated or diversified portfolio protects you from that risk, how does that make its way into material downtime and revenue losses for companies? How does that make its way into material losses for bank portfolios? There's just so many different ways in which you can think about these types of metrics, but the metrics have to be materially relevant for the companies that are thinking about integrating those tools.
Thank you. And David, the same question to you. And but if we can quickly go on to, you half mentioned it earlier. Sadly, with Georgina not here today, I was looking forward to a good debate between you and her on this IIGC, is it called CIF? CRIF initiative, which you see as a breakthrough. She, I think I'm fair to say, didn't, or at least in its current manifestation, she doesn't. But coming back to the point that Jeremy was covering and my question, how could we get integration? Is it going to be an initiative like this, even if it's not perfect?
Yeah, I mean, like every approach has its limitations, but I think this is a very strong step in the right direction. Investors want consistent, sound frameworks. Now, this particular framework, as it stands right now, it has plans for expansion, but it's focused on infra and real estate. And I think that it's effectively allowing investors to kind of, I guess, for the resilience costs and the beneficial costs of any adaptation and resilience that you apply to come out at the end. So if, for example, you find an asset that could be particularly exposed and there's an adaptation and resilience cycle that needs to be sort of ran, this part of the CRIF is dependent on what's called the PCRAM, which is a physical climate risk assessment methodology. And it's a standardized logical approach effectively to try and create an interim or an integration point between the engineering and the asset setup and translating that into something understandable or useful for an investor. So yeah, I feel that it is a very good step in the right direction. I think it goes a long way into making those points and for integration, because like you say, as Jeremy was saying, once you find the risk, it attempts to quantify that, and obviously that's only as good as your risk assessment tool and your data. And then from that, then it will say, look, this will be the cost of an adaptation approach, and this will be your returns over time, or how quickly you can overcome that cost. So I feel like it's a very strong step in the right direction, to be honest, for standardization. As we said at the start, investors are crying out for some form of standardization, to be honest. So yeah, I think this is something I support.
Okay, we've sadly not got a long time. I see we do have a few questions, so quickly, can we maybe do a sort of rapid round, short, sharp responses to three very different looking questions? The first one, I think, is how do smaller and medium-sized pension funds take a different approach to the larger ones? I guess, Chris, you should be if you could do in terms of what you do with your clients, is that the case? You mentioned the largest pension fund in Canada, and there's the Maple 8. I love that term, the Maple 8, and the Aussie Supers. These are monster-sized entities. I was quoting Northern European, very large pension funds, etc. If you go down the scale into the smaller investment houses, is it very different, or somewhat different?
I think it's more mixed. In that the overall level of resources that can be deployed is clearly lesser, but really it comes a little bit more down to sort of that, again, equilibrium between conviction and internal conviction and managing external reputation. The very largest pension entities really are focused on managing external reputation. They don't want to do anything really bad about climate, but on the other hand, you can't move the super tanker too quickly. So we certainly have seen smaller pension entities that have really have from an organizational, a governance, a board mandate level have really pivoted to say, we are really going to put a greater priority on climate risk. You also see things such as family offices, very interesting when you have generational change and the new generations come in who are much more focused on climate. The one comment that I would have, just actually coming back to David's point, I think governance is key. And one thing that we see in the larger pension entities is really a traditional 3 lines of defense model. So you have the front office as the first line making the investment decisions, then a second line of risk management and a third line of internal audit. ESG climate is part of the second line. And the question of integration is how do you move from being risk averse to value creating? So the first line typically wants to know, is there anything so bad here that I can't proceed? And as long as I'm over that minimum threshold, we're good to go. And that's exactly the same with the other world of operational due diligence. Is it going to blow up? Is it a fraud? No. Okay, we'll proceed. The question here needs to come, how can climate metrics actually be pivot and transferred into a value creation mechanism? And some of the smaller pensions, I think, are actually further ahead with that.
Oh, that's interesting.
Simon, yeah. Can I add to that just real quick?
Absolutely.
Nothing as insightful as that, but I think that just from a purely practical standpoint, big pensions and big asset owners, asset managers want data. They want to integrate it into their process. Smaller, less resourced companies want tools. So they want something that gives them the information. So I think that the information's out there, but it oftentimes does depend on resourcing and the ability of sort of to work with the sophisticated data, giving those resources.
And First Street's your clients, I guess, do they range in size from the big to the small and everything in between?
Yeah, and so we deliver data and enterprise suite access to big companies, but then a lot of the smaller asset owners, asset managers just want access to our portfolio tools and our enterprise suites.
Okay. And there's quickly, because we're again rapidly running out of time, maybe more for you, David. Why is he or she has put renewables so dominant in allocations? I don't know whether you want to have a go at that. Next Energy Group. Is this right? This is a sort of like a softball pitch, isn't it, for you?
I was going to say, it might be one aimed at Chris. I can do my best, Boris, but I'll pass the floor to Chris first. But I do have 1 or 2 points that I could add, but I'm sure Chris will cover them. So Chris, have at it if you don't mind.
You need to do this in seconds.
In 10 seconds, I'll be very cynical and I'll say because a photo of a wind farm looks amazing on the front of the annual report, and I'm not kidding. So back to you, David.
Solar is cheap. I mean, if you look at Texas, it's one of the highest deployers in the US, being a red state considering of solar. It's incredibly cheap to implement. So yeah, I mean, aside from the usual fossil, the fossil fuel sort of dependence issues that you get in the EU, I mean, money talks, right? In in America, in a red state, deployment of solar is enormous. So purely because it's cheap.
Well, I think that's what a perfect way to end this sophisticated conversation. Renewables doing well because it looks good on brochures and it's cheap. I think that's probably a good way, the good takeaway from this particular discussion today. I was sort of basically running out of time. I wanted to thank First Street very much indeed for sponsoring this occasion. For this, I have genuinely, it's been a really, really interesting study. I could have talked the whole hour, or indeed 2 hours, about more of the findings. I tried to select some of the more interesting or controversial ones. Not that they're that controversial, but the full results, as I said earlier, will be in the November issue of Sustainable Investment Intelligence, which should be out next week. And we are going to be pursuing this in a number of different ways, both talking about tracking different ways that investment management groups, GPs, as well as the LPs are using this data. It's a huge project, we know that, but we are, what did Chairman Mao say? You've got to start with this one step for the 1,000-mile march, or whatever it is. So we're calling this the Climate Risk Tracker, and it will hopefully start in the December issue of Sustainable Investment Intelligence. So those of you around the world who follow us, and those of us who are going to be seeing this in the future, which I understand is going to be many of you, thank you for your attention, and hopefully see you all the next time. Goodbye, everybody. See you. Bye-bye.
Thanks, folks.
Thank you all.